afternoon all, and thank you so much for joining today's webinar where we will provide an insight into Oman's new VAT law, which was published yesterday. Today we are joined by Orifa Middle East Tax and Thomas Van. He will take us through the new VAT law. He will also give practical tips on how to prepare in the next 6 months before the commencement date of the law. Before I hand over to Thomas, just a couple of things that I'd like to cover. So if you've got any questions during the webinar, please submit them via the questions box to the right-hand side of your screen. We will answer these questions during a dedicated Q&A session at the end of the webinar. If you also experience any technical difficulties during the webinar, I would recommend that you refresh your browser. If that does not work, please send me a chat message as well via the questions box, and I will try and resolve the matter quite quickly. Other than that, I'd like to thank Thomas for partnering with Lexis Nexis on this webinar today, and I will now hand over to him to start the webinar.
Thank you very much, Marley. Also on my behalf, thank you all for being with us. I'm just making sure that I've got my phone next to me to time right, because we've limited the timing for this webinar to 1 hour. So we've had the introduction so far, and we will be covering the technical aspects of the Omani VAT law in the next 45 minutes, leaving then around 10 minutes still for Q&A. As Marley said, feel free to communicate any of your questions. This was a bit of a sprint to get everything done, because as you might know, VAT law in Oman was only published yesterday around noon. We had a bit of a heads up a few days ago on the 12th of October saying that would be published today, yesterday on the 18th, and so we managed to quickly put together this presentation in order to share the contents of the Omani VAT law. So in the next 45 minutes, I'll take you a bit through the wider context of the VAT implementation of the GCC and in Oman, and we will dive deeper into the contents of the Omani VAT law. We'll also have a look at what is next now in terms of timelines for businesses in Oman or dealing with Oman. And the last part on the lessons learned, I will skip that, but it will be part of the slide deck that will be sent to you after the training. For those of you who did not see on social media the copy of the Omani VAT law, feel free to reach out. We will send you a copy, and I'm sure also that Marley will make the VAT law available on the Lexis Nexis platform in a later stage. So for those of you who are joining in late, thank you for joining. In the next 45 minutes, we will take you through the VAT law in Oman. Now, the implementation of VAT in Oman is part of a broader movement. You can see in front of you 6 pictures of the GCC countries. The reason is that all of the 6 GCC countries had agreed to implement VAT already quite some time back. The agreement there to the treaty was signed in November 2016 by the 6 GCC member states, but it was under negotiation for quite some time. And as most of you will know, up until now, out of the 6, 3 have implemented VAT. That's UAE and KSA on the 1st of January 2018, now 2.5 years, more than 2.5 years down the line. And Bahrain followed 1 year later on the 1st of January 2019. And all of the 6 countries should have implemented VAT by the end of 2019, but we know that in the end, did not take place. And so if we look at the status, Oman is going to be the next. It was for a very long time unsure whether Oman would introduce VAT and at which point, but now we're there. The other states that should follow are Qatar and Kuwait. In Qatar, there's a few signals that things are moving forward. And so we expect in 2021 Qatar to introduce VAT. And in Kuwait, the discussion is a bit more difficult because of political issues simply. The parliament disagreeing with the introduction of VAT, whereas the Ministry of Finance very much wants to introduce VAT. Now, if we then look at Oman, as said, the topic of the webinar is obviously the VAT implementation in Oman. So that means that it's moving forward. But in the wider context, looking at why it introduces VAT, already pre-COVID-19, there were a number of fiscal challenges for the Sultanate of Oman. And with COVID-19, these challenges, they've only been exacerbated by the current sanitary crisis. In terms of what revenue it would bring to the Omani treasury, it is relatively modest. It's estimated at $780 million and would constitute between 1.5 and 3% of non-oil GDP. What does that mean specifically for the budget is we expect a positive impact obviously in 2021, but only partially in 2021 due to the timelines of the implementation that we will highlight in a second. And we saw already that the introduction of excise tax in 2019 had a positive impact on the budget, where the tax revenues were up 8% compared to the year before. So bit by bit, Oman is turning up the heat and trying to collect additional tax revenue. An important element as well is that the forecast for the revenues in Oman in 2020 is based on an estimate of an average oil price of $58 a barrel. The current price for a barrel is around 43%, and the IMF has projected when it looks at the fiscal balance of Oman that the price which is required is $87 a barrel. So we're very much far away of this fiscal balance, and that's therefore the reason also why the introduction of VAT in Oman has gained momentum. To the VAT law then itself, as mentioned in the introduction, we received the heads up on the 12th of October. So the Sultan had already published a document saying we will publish the VAT law in Oman on the 18th of October. That was yesterday. That was done as well. The introduction to the VAT law says that VAT will be introduced 180 days as from the publication of the VAT law. So that means that we've got time up until around the 18th of April 2021. Other important elements there is that there are executive regulations to be issued in Oman, and we are expecting those to be issued in December of this year. We will get back to those regulations in multiple instances in a bit. Also important is that we expect the registrations to be open in January 2021. So that's going to be around 3 months before the effective implementation of VAT. That is on par with the other jurisdictions so far, I would say. But we always see that there's a great deal of last-minute registration still going on. We've had our first guidance as well already from the tax authority, from the Omani tax authority, where it has issued FAQs for individuals and businesses and information sheets. So we can see already there that it's starting to release information bit by bit, and we can expect that rhythm to increase as well in the coming months. Oman is not being greatly original in its implementation of VAT so far, except for a few minor points. So we can really expect things to be, I wouldn't say fully like the other GCC states, but at least a bit in line with the other GCC states. Now let's have a look, of course, at the coveted Omani VAT law. For those of you, again, who have signed in late, feel free to reach out to receive a copy of the Omani VAT law. We've made a translation in English, and I'm sure that translation will also be made available at a later point on the Lexis Nexis platform. Looking at the Omani VAT law, I said it a few times already, there's not a great deal of surprises. It is very much in line with the GCC VAT framework, which is the treaty signed by the 6 GCC member states, as mentioned. That GCC VAT framework is derived from the EU VAT directive, in the UK sometimes referred to as the principal VAT directive. But it is derived from its 2010 version, and it shows you how long it took to negotiate the GCC VAT framework. If you look at the structure of the Omani VAT law, it looks very much like the UAE VAT law. Of course, there's not 10,000 ways of structuring a VAT law, but it is obvious that some inspiration has been drawn from the UAE. As expected, 5% standard VAT rate, so not like Saudi 15, with a number of exemptions and zero rates applicable, and also out of scope supplies, which have been literally mentioned in the law as well. I would term the Omani VAT law as a skinny law because it has 106 articles and only 36 pages, and it refers in a great deal of places to the regulation. And so, especially the regulation will then provide a lot of detail for this. The important thing to note on the regulation is that any amendments to the regulation can be made by the tax authority itself. So it doesn't have to go through the cabinet of ministers. The reason why that's important is that we can expect the framework to be amended multiple times over time. If we look at Saudi, the General Authority of Zakat and Tax has the same power, and there it has changed the VAT law already 4 times. So we can also expect this to be done in multiple occasions. If you look at some of the basic concepts of the GCC VAT framework, they are simply reproduced in the Omani VAT law, whether it concerns the scope of tax, the place of supply rules, taxable value, liability, and date of supply rules. Everything which is in the treaty is also in the Omani VAT law. It's not an entire obligation for Oman to actually follow everything which is in the treaty. It's more of a political soft commitment, and as we've seen, Saudi has already simply deviated from the VAT framework, and we've seen in the 3 GCC states so far that a lot of exceptions have been made to the treaty. So Oman could have very well simply deviated from the GCC VAT treaty, but luckily it stuck close to it, which helps a lot in terms of the foreseeability for businesses in Oman, which are now confronted with this 6-month implementation window. What else is important about the law is that Also, from a Omani perspective, there's no GCC VAT system. For those of you familiar with the GCC VAT framework, it tries to implement a system in which there is a real-time exchange of information between the GCC countries, and where there are special so-called place of supply rules applicable to transactions between the GCC countries. That is not in place. So up until now, the 3 countries that have introduced VAT, they have all pretty much blamed each other for not implementing VAT in the right way, compliant with the treaty. But if you ask me, none of them have done so so far. But so it means that whenever you have a reference in the Omani VAT law to a GCC country, you can disregard this reference because the rule will not apply. All GCC countries so far consider each other as third countries for VAT purposes. As you might know, this triggers some complexities in terms of the customs law, which interacts with the VAT law, because the common customs law has certain transactions where it recognizes the other GCC countries as GCC countries, but so that is not the case for VAT purposes. What does that mean in concrete terms? Any goods which are exported from Oman to other GCC countries, the VAT regime applicable to it is the equivalent of Oman exporting to non-GCC countries. The same thing for the import of goods and services from other GCC countries to Oman, which is subject to the reverse charge mechanism when the customer is registered for VAT purposes. That will also apply irrespective of whether the goods and services are received from other GCC countries or from non-GCC countries. First things first, very practically, registration threshold, bang on like the treaty. 2 types of registration thresholds, one voluntary one and one mandatory one. The mandatory one is the equivalent of $100,000. If a business exceeds this registration threshold, then it will mandatorily have to register for VAT purposes in Oman. If a business has turnover below $100,000 but above $50,000, then it can voluntarily register for VAT purposes in Oman. The same situation holds true for businesses which have incurred expenses equivalent to $50,000. They can also voluntarily register for VAT purposes in Oman. There's a great deal of reasons why you would do that, but I will skip those for the time being. Now, if you look at those 2 thresholds, $50,000, $100,000, there's 2 tests to be applied. One is the backward-looking test. Have I exceeded the $100,000 threshold in the current month and the previous 11 months? The other test is the forward-looking test. Do I expect to exceed the threshold in the current month and in the next 11 months, yes or no? If the answer to any of those 2 tests is yes, then you have the obligation to register for VAT purposes. So for businesses which are somewhere around this threshold, it's almost a constant exercise to monitor the threshold. Now, because the law was published yesterday, on the 18th of October 2020, businesses, they need to determine whether they meet that threshold as at October 2020. So not April 2021 when VAT will effectively be implemented, but it is to be determined now. The obvious reason for that is, given the element of surprise, there's no more potential planning around it to remain below the threshold for the small companies. What do I need to take into account when calculating that threshold is, on the one hand, the taxable supplies, so supplies of goods, services, and imports. Those I need to count towards my threshold. In addition, supplies which are subject to the reverse charge mechanism and which I, as an Omani company, receive in Oman, and then also intra-GCC supplies. Again, this refers to specific type of inter-GCC supplies. However, currently a supply from Oman to another GCC state would be zero rated and would therefore follow under the taxable supplies. Now, there's special types of registrations, very much following the VAT treaty. One is VAT grouping. VAT grouping is a tool which allows for multiple sister companies, multiple companies which are part of the same group, to group for VAT purposes their VAT liabilities and file one single VAT return. You can also offset outputs and input tax through the VAT group, and any supplies between members of the VAT group are outside of the scope for VAT purposes. So it's a planning tool. Don't take it as an admin simplification tool because I don't believe it is, but take it as a tax optimization tool. Another special type of registration is for non-resident persons. I always give the example of the Spotify's and Netflix of this world. If you're a non-resident business and you are making taxable supplies in Oman, for which you are liable to the payment of VAT, then you as a non-resident, you need to register in Oman for VAT purposes. That doesn't mean that you need a CR or a trade license in Oman. It simply means that you need a VAT number. The VAT experts who are listening in, they will understand this concept. For many businesses, this is a very complex concept to understand, and we would really have to have a VAT 101 in order to fully explain this. Importantly, though, is that for these non-resident persons, they can either register directly or through a tax representative. Hopefully, the Omani Tax Authority will be very lenient with the concept of a tax representative and with the direct registration, because in practice, simply for non-resident persons, if it is too difficult to register, most of them will not register simply. What is important as well is for these non-resident persons that they need to appoint a so-called responsible person. We'll get back to that concept in a bit. What happens if you get registered? You get a tax registration number, which consists of 50 numbers, which starts with a 6. So we've had 1, 2, and 3 so far. One for the UAE, Bahrain, which has 2, and Saudi, which has number 3. Oman's VAT numbers, will start with 6, and they will include 15 numbers. Similar to the other GCC member states, input tax incurred prior to registration. I have to clarify that. That means after implementation of VAT, but before registration, the input tax which has been incurred can still be deducted upon registration. For the grand majority of companies, simply they need to look at the status as at October 2020 in order for them to verify whether they meet the registration threshold. They will register in January and as from April start charging VAT. So this is only for businesses that don't meet the threshold or for new businesses and they register later. An important element as well, businesses that make exclusively zero-rated supplies, they can request for a exception from registration. So they don't have to register, they don't have to file VAT returns, they don't have to issue tax invoices. They simply need to get an approval from that, and that's reserved for businesses that only make zero-rated supplies. Now, Oman has made a collection exercise, a data collection exercise over the last few months, requiring entities to receive and obtain a tax card. So hopefully the registration process will therefore be much smoother, and especially when you compare it to, for example, the UAE, where there's no central company registered and where the tax authority was inexistent. In Oman, that is not the case, so it should go smoother when the registrations open in January. Now, what is subject to 5% and what is not? So a rule of thumb really for VAT purposes is always that all supplies of goods and services and imports are subject to 5% VAT, except when the law specifically says that they are not. So the exception is 0% and an exemption, and the rule is 5%. If you look at the treaty, as I said before, Oman follows the treaty. So what it has done is, if you look at the left column, it has zero-rated medicine and medical equipment, has zero-rated cross-border goods and passenger transportation, has zero-rated exports of goods, and has zero-rated transactions with investment gold, silver, and platinum. On the right-hand side, we have the financial services, which it has exempt following the treaty, and it has also exempt the imports of zero-rated or exempt goods. In the middle two columns, you see what policy choices that Oman can make. So in the middle columns, Oman could ask itself the question, do I want to have the supplies subject to 5%, or do I want them to be subject to zero rates or exemptions? We'll get back to the conceptual differences between the two. For now, just remember that for a zero rate and for an exemption, when you make that supply, VAT is not due. Specific policy choices of Oman, where possible, it has exempt supplies. This is very important because it is the first GCC state to exempt healthcare and education. What it has also exempt is undeveloped land or bare land. This is following the UAE's position on this. Same thing with local passenger transport and renting or resale of residential property. Those are all on the left-hand side and they are exempt. On the right-hand side, we see what has been zero rated. So the treaty allows to zero rate food items, and Oman has also opted to do so. What else? Crude oil derivatives, and natural gas. Also, sea, air, and land means of transportation used for the international transportation of goods and services. And then rescue aircrafts, boats, and auxiliary ships. So where possible, Oman has deviated from the normal regime. It has some further exemptions following the treaty as well. The exemptions which you see listed here, they actually come from the common customs law. And so what Oman has done is, where there is an exemption from customs duties, it has expressed the will to also apply an exemption for VAT purposes. So when I've got imports of goods which are used for diplomatic or consular use, customs duties exempt, VAT exempt. Goods used for the armed and security forces, the exact same situation. And all of them, the bullet points from the second one down, are all situations where in the common customs law, there is a customs exemption, and then therefore there's also a VAT exemption foreseen. The first bullet point is a logical consequence of a local, the application of a local exemption or zero rate. When that applies on a good and you sell it locally, the same regime needs to apply when you import those goods, because that benefits neutrality for those goods. It has also clarified a number of its zero rates. Classic one is obviously the export of the goods. Important for the application of these zero rates is that the conditions are met, and the regulation will specify which conditions need to be met in order for the zero rates to apply. So export of goods usually means I need to keep my customs document. Goods or services which are delivered in customs duty suspension, or services associated with goods which are in customs duty suspension, those are also zero rated. the re-export of goods which have been temporarily imported in Oman for certain purposes. And then the most important one, especially in the services business, is services rendered to customers who do not reside in any of the GCC countries. So read into that, as I said, who do not reside in Oman. When they benefit from these services outside of the GCC, except for when services are subject to a special place of supply rule. Especially this last bullet point is very contentious in the 3 countries that have introduced VAT so far. And to the EU VAT expert's eye, it does not seem very logic, because simply in the EU, when I've got a service which is rendered to a B2B customer abroad, the place of supply is abroad. So therefore here, we are hoping that the Omani Tax Authority will take a lenient approach in it, but we will only see this once the regulations will be published in December. I said we were going to explain zero rates and exemptions. In a nutshell, when a supply is standard rated, then input tax incurred is deductible. When a supply is zero rated, then there's no VAT applicable on the supply, but the input tax is deductible. So it's a fictional thing. It's a simplification in terms of the terms. It's as if I'm charging tax, but I'm charging it at a zero rate. And then there's also exemptions which look the same as zero rates in that the supply which I'm making is not subject to VAT. However, the input tax associated with making those supplies is not deductible. There's a 4th category, which is the special category, which I would divide into 2 types. One is the material outside of the scope, which means as a business I'm receiving income, but it doesn't constitute a taxable supply. Any costs which are associated with that income are not deductible. And there's the out of scope supplies, which are not real out of scope supplies, fictional out of scope supplies, which are transactions which I'm making, which are, for example, from a territorial point of view, outside of the scope of VAT, but they still grant input VAT deduction. A number of practical elements with the Omani VAT law. Import VAT will have to be paid to customs and later claimed as an input VAT by businesses. So this is different from the UAE, where there's an automatic deferral to the UAE VAT return. The Federal Tax Authority in the UAE terms it as a reverse charge, but it is simply a deferral. Oman will make available a deferral license upon request. So that means at that point, you don't have to pay VAT to customs, and you don't simply have to pay it in your VAT return. As we've seen as well with the other GCC states so far, prices of goods and services displayed, retail shops and all taxable persons, they need to be displayed inclusive of tax. So you cannot say this is the new iPad for 100 Omani riyals, and when you come to the cash register, it is 105. That is not allowed. In addition, record keeping, the taxpayers, they need to keep all their tax-related documents for 10 years and even 15 years in certain cases when it relates to real estate capital assets. So those are a few important elements already, which are very practical elements for the implementation. Once you're registered for VAT purposes, you obviously need to file a return. The deadline for filing the return is 30 days following the end of the tax periods. So in the UAE, we've got 28 days. In Saudi, it's the last day of the month. Oman is a bit different. Important as well is that, and this is a tool that many tax authorities resort to in the region, is that when a tax person does not submit his tax return, the tax authority has the right to estimate what tax should be in the tax return. So this is very often a contentious point where all of discussions take place with the authority. We expect that the filing of the VAT returns will be either monthly or quarterly, depending on your turnover. The statute of limitations in order for you to receive an audit on your tax returns is 5 years. And in case you have forgotten to register, it is 10 years. We don't know yet what the format of the VAT return will look like. We are rooting for a simple VAT return, not in the KSA style. And a last important point is that from a procedural point of view, there is currently in the Omani VAT law no threshold for correction. I need to clarify that. In the 3 countries that have implemented VAT so far, they have implemented in my honest and humble opinion, a too complex procedure to correct VAT returns, which depends on whether you exceed or not exceed a threshold of either 10,000 dirhams or 5,000 riyals in the case of UAE and KSA. Up until now, what we see for Oman, there's no threshold for correction. So what we're hoping for is that any mistakes made, they can simply be corrected in the next VAT return, but we cannot rule this out at this point, given the fact that it might be included in the regulation. An important aspect is also what, the special economic zones. What to expect for free zones and special economic zones. In both UAE and Saudi, we've seen that deviating regimes have been applied on these zones. Oman only refers to the special economic zones. It doesn't refer to the free zones. So that's the only type which is covered in the law. And it assimilates to the VAT treatment of transactions which take place in these special economic zones to the situation of a suspension of customs duties. So that means that when supplies are made inside these special economic zones, they will be zero rated, and any supplies of services which are related to these goods which are in a special economic zone status, meaning under customs suspension status, these will also be zero rated. Further details on this very likely to be determined in the regulation. What does my tax invoice need to look like? The Omani VAT law doesn't mention it, but the Omani Tax Authority has already released some examples of how it expects the tax invoices to look like. So the example that you see in front of you is an example given by the Omani Tax Authority. We expect this to change still a little bit because the VAT number also, which you see mentioned on the tax invoice, is not the final one. So you see pretty much what you would expect, which goes on a tax invoice. A few elements there which are important is tax authorities here are very formalistic. Unfortunately, they want the word tax invoice to be mentioned on the tax invoice. Up until now, it doesn't require you also to collect the VAT number of the customers and mention that on the tax invoice. So I would take for now what is on this example as the minimum requirement, but I would very much recommend you to verify again the regulation to be published in December in order to verify these elements again, because I assume that there are a few moving elements in the regulation. In terms of these tax invoices, whenever a business is making taxable supplies, it needs to issue a tax invoice. The simplified tax invoice, which is the equivalent of a tax receipt for most of the other tax and VAT jurisdictions. Under certain circumstances, we expect that businesses will be able to issue simplified tax invoices, and most likely that will be the case when dealing with non-registered customers, for example, supermarket sales. Another important element which is known already right now, which is when a foreign currency is used for billing and reporting purposes, in order for the conversion into Omani Riyal, the daily FX rates published by the Central Bank of Oman have to be used. It is compulsory. So again, that's a bit regretful because we've seen in the other 3 GCC states so far that it triggers a lot of complexities with businesses that cannot rely on their contractual FX rates or on third-party or systems rates. But it is what it is. Also, invoices always need to mention the tax amount in Omani riyals. The other conditions and requirements for tax invoices, those will be detailed in the regulation to be published in December. If we then look at input VAT deduction, so businesses making taxable supplies, whether at 5% or 0, they can deduct input tax. Input tax is in a certain amount of cases not allowed, and that is the case for so-called prohibited goods, for which it is not allowed to trade them. VAT will not be deductible for them. For mixed taxpayers, i.e. taxpayers that make both taxable 5 or 0 and exempt supplies, the mechanism in order to calculate the input VAT deduction is not yet defined. That will come into the regulation. The same thing holds for so-called blocked items, which are usually items which are used for entertainment, or items which suggest personal or private use when goods or services are bought by a business. That will also come into the regulation. The good news in terms of the input VAT is that Oman is much more lenient than the UAE is, because it allows for 3 years to deduct the input VAT. So at any point in time in Oman during those 3 years, the input VAT on a taxable purchase of goods or services can be deducted. So that's much more lenient. So we expect that the implementation, therefore, in Oman will also be a bit smoother. Refunds, we've got tourist refunds available in Oman. There's also diplomat refunds, and there's also business refunds. So foreign businesses incurring VAT in Oman, for example, a Saudi business attends a big conference in Muscat and incurs VAT as a result of that, the entry fee into the conference, for example, that VAT
Good afternoon, ladies and gentlemen. Sorry, we've experienced a technical difficulty just from the presenter side. Please stay online just for the next 2 minutes to give him some time to reconnect. And then we will move on to the Q&A session.
Hello?
Hi, Thomas. Welcome back.
I cannot see the Marley, can you drop me a message just saying that whether you can hear me or not? Apologies for everyone for the glitch over here. Marley? Okay, you can hear me. Okay, fine. I'm just trying to fix the slides. Apologies for those of you who are who lost me there for a second. I need to just I cannot move the slides anymore right now. Okay. Thank you. One of my friends is signaling also that he can hear me. Just 1 second. Apologies for this glitch. Sometimes these things happen, unfortunately. So just bear with me for 1 second, and I'll be back to the slides. All right, I think we are back, and there we go. Good. So apologies for this little glitch. It happens to the best. So we're back. I was at the refund schemes. So I was saying that the business refund will be available as well. Importantly, are transitional provisions. And so for transitional provisions, what is important is these try to tackle when people want to play around a bit with the introduction of VAT, thinking before VAT will be introduced, I will make sure that I invoice a number of supplies or that I receive a number of advance payments as well. The transitional provisions, they mention specifically that whenever a invoice is issued or a payment is received for a supply which is effectively made after the implementation date of VAT, then it will be considered that this invoice or advance payment is part of that supply made after the introduction of VAT, whether that's a good or a service. It applies the same rule also for pre-registration invoices and payments. This is the transitional rule familiar to the VAT experts which have logged on. The second thing which is important there as well, and this is good news for the lawyers, all contracts, they need to be amended, because where contracts remain silent on VAT, they are considered, the fees which are stated in that contract, these are considered to be inclusive of VAT. Maybe, like the UAE, these rules will be softened a bit, but this is already a clear signal that the contracts need to be revisited for all businesses. Continuous supplies, which are traditionally the telecoms and utilities contracts, for those VAT is due on the proportion after the implementation of VAT, and the proportion which is before the implementation of VAT is not subject to VAT. Now, a very important concept which is unique to Oman is the concept of responsible person, or sometimes referred to also as the principal officer. It is a person who, from a corporate law point of view, has certain responsibilities towards the company, whether that's representing the company as a director or a manager or as a partner. You are considered as the responsible person. And as the responsible person, you can also incur quite heavy fines. This responsible person cannot exit Oman for more than 90 days during any tax year. To be honest, if I would be the responsible person, I would start feeling a little bit uncomfortable when I see the very hefty penalties. A few examples of penalties which are punishable by imprisonment. You intentionally don't register for VAT purposes. You intentionally fail to include the correct data on the tax return. Of course, evasion of tax, that's something that we're familiar with, but also if you intentionally don't have your records in place. So this is much more strict than UAE and very much in line with what we've seen for Bahrain as well. What is punishable with imprisonment of more than 2 months and less than a year, or a penalty of more than 1,000 Omani riyals and less than 10,000? You see the cases there described before you. For example, it is the case when you don't appoint a responsible person, when you don't submit deliberately a tax return, if you don't keep proper accounting records and books, if you don't have compliant tax invoices, and so on. So quite strict, but that's not all. What is even more strict is the cases punishable with imprisonment of more than a year and less than 3, for a fine in excess of 5,000 Omani riyals and less than 20,000 riyals. There you can see, for example, if you don't register for VAT purposes with the authority, this is really something that is only is unique to this region. The punishment is extremely harsh. We can understand it obviously for submission of forged tax returns, which is point 3. And another point that I want to highlight, which is point 5. This is a taxpayer receiving assistance from a third party in order to reduce its tax liability. So to a certain extent, advisors and whatnot, they can be caught by this provision. What other penalties? The regulation will specify additional administrative penalties as well, on top of the ones that we've seen. There is also the, not mentioned here, but I'll make sure to add that in the last version of the slides, a 1% surcharge or additional tax per month that the payment came late. And an interesting concept so far, and I would maybe ascribe this to the more accommodating and laid-back nature of the Omanis, is that with the chairman of the tax authority, you can agree to a reconciliation. So you can have a settlement on your case, provided that that is done before the issuance of a final judgment by a committee or a court, and that you pay at least twice the minimum limit and not more than twice the maximum limit of the fine for the violation, then you can reach a reconciliation or settlement with the authorities. Of course, you'll get into disputes with the tax authority, as we've seen many-fold as well in the UAE so far, but also in Saudi. If you receive an assessment, you've got 45 days to object against the assessment. Once you're in the procedure of the tax dispute, you can request for a deferral of the payment of the tax with the chairman of the Omani Tax Authority. And the Omani Tax Authority gives itself a lot of time. It gives itself 5 months to consider the objection. And this 5 months objection period can be extended to, by 3 months. So especially this is good, I think, because a lot of litigation will start as from April of next year. This shows that in the end, the Omani Tax Authority will give itself the time to build up its capacity and whatnot, and to render the decision. I won't bore you with too much with what is next for businesses in Oman, but I do want to stress one thing, which is the timeline and the preparation. If you fail to plan, you plan to fail. Essentially, as from July already, when we held our first webinar, on this flagging that VAT would come, and we made the right prediction in terms of saying that VAT would come in April. We need to take the next 6 months really to prepare for the introduction of VAT. I would say don't underestimate the amount of preparation. Choose the right advisors, choose the right software as well, and don't underestimate the budget that you're going to have to spend for this as a business. It is at first sight a simple tax. As you might learn from the experience in other countries of other people, there are a great deal of nuances which make the practical application of VAT more complicated. I suggest we now go to the questions. I will send you a copy of the slides, obviously, and also a copy of the VAT law. But let's open the floor to questions. I don't know, Marley, if you can guide me somehow, because I cannot click open the questions box on my screen. I cannot see my arrow, so it's not possible.
Can you confirm that you can hear me? Thomas, can you hear me?
Wait, now I can see them. I cannot hear you now, Marlene. Okay, you'll send the questions via chat. Okay, at this point I cannot see any questions in the chat, so I stopped sharing my screen fully, and I'm just waiting for now for any feedback that you might have or any questions that you have on the law so far. Oh, okay. I was looking in the all right. Okay. Is it mandatory for a company in Oman to appoint a tax agent based in Oman? There's no such thing as a concept of tax agent in Oman. I would say luckily. You do have to appoint a responsible person, and foreign taxable persons have the option to register directly or appoint a fiscal representative. In terms of Article 21 of the law, that's already more of a specific question. Yes, there is indeed a part which is deferred to the regulation, which refers to inter-GCC supplies. So it does imply implementing states. That's correct. Residential buildings will be taxable. That's correct. It will be subject. The sale of residential buildings will be subject to a 5% VAT rate. In terms of the loan to develop a commercial residential building, the loan itself would be termed as a financial service, and those will be exempt. And so in that sense, there's no input tax which is related to that loan in order to develop the commercial residential building. For non-residents, as mentioned, tax representative is not mandatory. The resale of residential property is indeed exempt. The first sale will be taxable, and any subsequent resale will be exempt. If an individual sells a car to another, is it subject to VAT? The classic question. You need to ask yourself whether you are conducting an economic activity of the sale of cars. So if you do it on a regular basis and in an independent manner, then you will constitute a taxable person. So the concept of taxable person is not reserved to companies. It can also be individuals. If you are a car salesman in your individual capacity, then as the individual, you need to register for VAT purposes, sell the car subject to VAT. There is a used goods scheme foreseen in the law, but the detail of that is deferred to the regulation. Is there a need for non-resident persons to engage in services related to real estate to register if their customers are only Oman VAT registered businesses? I would expect that this non-resident person does not have to register in VAT in Oman. As from now on, the law is not 100% foolproof and clear on this. So I expect this to be covered in the regulations. In terms of inter-branch transactions, I expect Oman to follow the same thing as the 3 GCC countries so far. Branches within the same country, any transactions between them will be outside of scope. And I expect also branch to head office to branch to be outside of the scope. Currently, it is not specified in the law in Oman. What is the benefit or disadvantage of input VAT deduction? There's actually no disadvantage of input VAT deduction. It will reduce your output VAT liability, so it's beneficial for you. But when comparing to 3 years or according to the UAE VAT conditions, for the UAE, you've only got essentially 2 periods to recover, the one in which you receive the compliant invoice and that you have gone through the procedure of approval and the next period, whereas in Oman, simply you've got 3 years. Transition and VAT treatments on pre-registration transactions. So if the transaction from a date of supply point of view has taken place before the implementation, it remains outside of the scope of VAT. For the transactions that I mentioned, advance invoice, advance payment, but for transactions which take place after the introduction of VAT, those elements are subject to VAT. Contracts which have been concluded for continuous supplies, also the portion before the introduction of VAT outside of scope, the portion after will be inside the scope of VAT. If the contract is silent, I would say at this point, amend your contract, make the contract stating that the fee is exclusive of VAT. But indeed, at this point, if the contract is silent, then you cannot charge VAT on top, which means that the 100 that you've agreed as a fee is VAT inclusive. So you still have to charge VAT, but the fee that you're getting is VAT inclusive, which essentially means that you are reducing your turnover and therefore also your profits. What do we mean by statute of limitations? 5 years if you're registered and 10 years if you're not. So the audit period open to the tax authority is 5 years. So during 5 years, they can audit your VAT returns. If you haven't registered for VAT purposes, they can audit 10 years. That's the difference between the two. A share transaction, yes, the sale of shares would be considered as a financial service. We need to see the detail in the regulation, but what I would expect is that Oman is going to take a little bit of a different approach than the 3 countries so far, and will have a more wider FS exemption in Oman. But any transactions related to shares, indeed, they are considered as a financial transaction, and therefore exempt from VAT. Contract advances received prior to implementation of VAT on long-term construction contracts. It's probably one of the most contentious issues in the 3 GCC states so far. It highly depends on the contract and what you're supplying. If you've got milestones, and those milestones are specifically identified, and part of them fall before the implementation of VAT and part of them fall after, then only the ones that will be after are going to be subject to VAT. So capital assets, if capital assets are acquired before the introduction of VAT, then nothing needs to be done with them. It's only after the introduction of VAT in Oman that the capital assets need to be monitored for their use. So they need to be monitored for a period of 10 years. Tax invoices in Arabic. So far, there's no hint that everything needs to be done in Arabic. There's no language provisions. We expect Oman to be a bit more lenient than, for example, Saudi. So we expect that English will be acceptable, but I cannot fully confirm this for now. In terms of the free zones, it's only special economic zones, not free zones. Indeed, supplies within the special economic zone are zero rated, not exempt. And the same thing for services associated with it. Mind you, because of the reference to customs duty suspension regimes, retail sales within the special economic zones, they will not be subject to a zero rate. Supply there. A large portion of input and output VAT would not be exempt, but would be zero rated. The next question is missing out on reporting commercial rents. Will the date of issuance of the tax invoice be within the tax period where we have corrected the amount? Should we use the date of the original tax period? You can never defer the date of issuance of a tax invoice. What determines the period in which you need to report the VAT is not the tax invoice, it is the date of supply. So if you miss out on reporting it and you report it in the next VAT return, which so far as we can see from the law will be possible, you can do that. But if you get an audit from the Omani Tax Authority, you will be hit with the additional tax or additional charge at the rate of 1% for every month which it is for which it is late. Threshold for fixed assets transactions for input VAT, there is none. So you can simply deduct the input VAT in full for fixed assets, which are termed capital assets under the law. A supply of services from a company outside of Special Economic Zone 2, Special Economic Zone 0 rated, no, that will not be the case. It will be subject to the standard rate of VAT. Okay, that was all of the questions. If you have any further questions, feel free to connect with me on LinkedIn or privately. My email is thomas@orifer.tax. My phone number is +971 for the UAE 582633018. So that's 0971 582633018. We will share the slides with you and the law, and then feel free to reach out. I'm sure that there's going to be much more questions, and in any case, we'll see you back in December when the executive regulations will be published. In the meantime, please do proceed with preparing for the introduction of VAT to not be surprised in the end. Thank you very much and have a good rest of your day, everyone. Thank you. Bye-bye.